Hey, everybody, welcome back to another episode of Cash Flow Positive. I'm your host, Kenny Bedwell. And boy, oh boy, I can't wait to get my studio. I'm getting a custom studio design for in my house, just in my office, like a little nook. And we're going to make it noise proof. I know it was funny. I got some comments from people in the last episode I did by myself. They're like, yeah, we heard your daughter yelling in the background. Life, right? Kids in life and working from home. So everyone can, I guess, relate, hopefully. But anyway, so I'm looking forward to that. But what I'm looking forward more to is opportunity in the marketplace today. And that's exactly what we're going to talk about. Is it a buyer's market right now? Is it truly a buyer's market? Okay. Because interest rates are up. Housing prices, let's be honest, they haven't really gone down that much. Maybe gone down as much as what we had expected. If you're looking to buy, I mean, it really isn't that easy to find deals. So when you hear it's a buyer's market, is that actually real? So let's dive into it today, break it all down, and then in the part 2 episode, I'm bringing in an expert. I'm going to bring in a lender. Don't worry, we're not going to be talking about loans. But we're going to be talking about conditions in the market and whether or not it truly is a buyer's market. So definitely want to stay tuned for that episode. Really good content. It was actually really, so just FYI, I record the part 2s before the part 1, so I don't I don't say the same thing twice, or it builds upon each other. So it makes it a little bit easier. But funny story real quick. The part 2 episode we just did earlier today. In the middle of it, we lost Wi-Fi connection, and it was getting really good. We were talking about we were having good conversations about the government decisions and interest rates and all these things. And it was kind of about the economics and where we see things are going and blah blah blah. And then all of a sudden the Wi-Fi cuts out, and everything else was working fine. It was just the Wi-Fi on one of our computers just died, but in other parts of our houses, it was fine. And so we put it on pause, and we were able to come back within 5 minutes. But it just made me chuckle because I was like, they're listening. They were shutting us down. So anyway, you definitely want to pay attention to that episode. We made it through. Hopefully it gets posted and there's no issues with it. If there are, you know why. So anyway, stay tuned for that episode. Okay, let's dive into it. So I really want to give you 5 kind of indicators that I personally believe it is a buyer's market right now, although it's still challenging to find really good deals out there. So let's talk about what a buyer's market is before we get into the indicators. So a buyer's market is basically buyers have the upper hand in negotiating, meaning that there are less buyers than there are sellers. So there are more houses for sale. So I just saw a stat. I'm sure you've seen it too on social media. It's oh, wow, the inventory, there are 500,000 more homes for sale than there are active buyers in the market today. Okay, 500,000, which there hasn't been that many since 2008, which we know what happened in 2008. So people are well, is this signs of the times, recessions? What's going on? But we still have a housing inventory shortage. Okay, so back in 2008, we didn't have an inventory shortage. Today, we have, I think it's 3 or 4 million homes of a shortage. So even though there are more homes for sale than literally approved buyers to buy them, there's still a housing shortage, and just the prices aren't aligned yet. And therein lies the opportunity. Okay. So that stat is based on residential real estate, not short-term rental real estate. So what that means is that, it could be different for short-term rentals, but we don't actually have that data. However, if you go and look at primarily vacation rental markets, say the Smokies or Kissimmee, Florida, near Orlando, Destin, Gulf Shores. These are vacation destinations. Usually the houses for sale are vacation rentals. And we can make that assumption that 90% of the houses for sale are vacation rentals, okay, or 90% of the properties for sale are vacation rentals. If that's the case, then we can use those markets. And what we're seeing is actually much extreme. It's extremely higher, meaning that the inventory compared to previous years is 100, 200, 300% higher than it was, in previous years. And there's a lot more selling going on than buying. And this is, for example, the Smokies. I think there was like, oh my gosh, I'm going to use a range because I don't remember the exact number, but it's like 1,200 to 1,600 homes. And it could have changed. This was a few months ago when I looked this up. It's definitely higher, or, on the higher end of this. It could be higher than 1,600, but 1,200 to 1,600 homes for sale actively in Sevierville County, excuse me, where, for the Smokies. Whereas like in 21, 22, there was like 500 homes. That's a big difference, right? So there's a lot of people selling, and there's a lot of people exiting the short-term rental space because it's gotten more time consuming and it's not as easy as it was before. I talked about this in the last episode. If you haven't listened to it, go back a week. It's really good. I forgot the name of it already. So, but I talk about like what's happening in the market, like kind of like runway and projections and things. But right now we're seeing a lot of sellers wanting to exit. Now, the problem though, is just because they're wanting to exit doesn't necessarily mean that they are able to, right? However, we are seeing a lot of sellers think that they can sell their homes at a premium because, they maybe put a lot of money into it, or they think it's just worth more, or they think it's 2021 still and it's appreciated all this money. Like we're seeing all these types of, sellers, like I can sit on the interest rate and the property can break even because maybe they bought it in 21 or even maybe 22 and just hold out and keep a higher purchase price in hopes that some gullible buyer will come in, swoop in and buy that property because they fall in love with it for whatever reason. Typically the excuse is, oh, well, somebody might buy it just as a second home, to own. It's like, come on, like, be realistic, right? Like you've overpriced it. It's really not worth that. Give me a break, And so obviously I have these conversations a lot with some, like, it's kind of a high price. And they're like, well, somebody could come along and, offer me cash for it. And I was like, I guess they could. Good luck. Call me in 30 days when it still hasn't sold yet, or 60 days, better yet. So properties are on the market and they're sitting longer. I think the average median listing time on the market is 56 days. Once again, that is not vacation rentals. That is residential homes. But I'm sure it's probably about the same, especially for vacation rentals that really aren't in desirable locations and have amazing views in those moats. And really, you're going to see some properties that are incredible and amazing and have good numbers. They're going to go like that. Whereas other properties that maybe don't have the views and aren't incredible and don't have a moat, the thing that separates you from everybody else, they sit a while. But sellers are a little more reluctant to drop prices. That's why we haven't seen prices come down yet. And so with less buyers in, because prices are still high and interest rates are still high, I believe that gives opportunity for purchasing now. Why now instead of, say, 4 months from now? Well, guess what happens at the end of the year? Everyone who's trying to offset W-2 income or just basically get tax savings, through bonus depreciation, okay? They're rolling in and they're waiting and they buy towards the end of the year, starting around September, October, November, December. That's when I start getting really popular. And everyone's like, I want to be your best friend. Can you help me find a property? And it's like, sure. Where were you in January? When I had no friends. Just kidding. I have, I guess, I don't know if you can call your mom your friend, but whatever. I'm just kidding. I have friends. But the reality is there are a lot of people wait and buy at the end of the year for the tax savings. And it's just a lot more competition. So between now and about September is a really good opportunity to start hunting, start your search process if you're planning to buy this year. Okay. I understand interest rates are, up in the air. Sometimes they go up 1 week, sometimes they go down one. But when we say up and down, it's within maybe half a point. Okay. It really doesn't fluctuate that much. And to be frank, it hasn't fluctuated for years. Around end of 2023, even 2023 was pretty high. I think it was like the peak. It was like eights. Okay. In 2024 and now it's literally just been in the sevens, like low sevens. It depends on the loan type and all this other stuff. And if you're just looking at like the 30-year loans, they're at 5.5%. And that's not for vacation rentals, by the way, but just that's kind of like the standard, like when we're tracking interest rates, like that's like the standard one at 5.5%. It doesn't mean you can get that for DSCR or your second home loan, depends on your lender and all that other stuff. But 5.5%, it's been like that for months, many months, year and a half, almost 2 years. So interest rates really aren't going to change. And we don't know if they are. They're probably just going to stay around what they're, maybe dip down a little bit, but we've got that range. So if that's not going to change, and we know a bunch of buyers are going to jump into the market later, when's the best time to buy? Probably now. Well, the reality is the best time to buy was yesterday, but that's hindsight, right? So the second best time is today. So you buy today. So that's kind of the first little argument, I should say, on why I believe that it is a buyer's market today and why you should take advantage of it. Point number two. Because short-term rentals have gotten more expensive. And when I say more expensive, talked about this last week too, you have to be willing to invest in your property. You've heard me say that. Hopefully it's echoing in your head and you're like, Kenny said, like, yep, that's you learned that thing from me. Great. So you have to be willing to invest in your property, which makes investing in short-term rentals more expensive. When things get more expensive, less people buy. So the rate of supply has significantly gone down. The supply increase has gone down in the short-term rental space. Now, Kenny, the overall supply has gone down? No, not at all. It's still increasing, just like demand is still increasing. However, the rate of increase, that percentage, is down. In 2024, it was at about 7%. This year, at this same time as of last year in 2024, 2025, it's at about almost 5%. So we're seeing about a 2% dip in the rate of increase of supply. I mean, it's not like that big of a difference, but 2% is still less people entering the market, less people trying to buy when we have more inventory. Now, going back to the whole argument, does that make all that inventory good? No, not at all. Most of it is crap, but there's less competition for it, which leads me to this other point with the whole supply growth. Because there are less buyers in the market today, there are less need for escalation clauses and even offering an asking price. Like, we never offer an asking price now. I mean, it's very rare. I should never. There has been one property in the last 2 months that we actually escalated and we offered over because it was underpriced, way underpriced. And we knew it was an amazing deal. We're like, holy crap, this is an amazing deal, not at $650 when it's asking, but it's an amazing deal at $750. Let's offer $705. And we got it at $705 and it appraised for $750. Boom. Or $760 actually. Gotta get the numbers right. So the fact of the matter is that for most properties, you can get some sort of seller concession or credit or price deduction. In all deals, sellers are becoming more, as the market softens, sellers are becoming more and more willing to negotiate. And we are seeing more opportunities. And most of our clients, most of the properties we're buying today, we are not paying for asking. We're not paying at full cost. We go through inspections, we take time, we go back and forth with them. And lo and behold, we're getting what we're asking for. Okay, doesn't mean we get everything and we just lowball everybody. No, not at all. But we are getting some sort of concession or price drop or whatever that is to make the deals work better. And that is going on now. If I wait 3 months from now, that's still going to be going on. I think it's going to be going on throughout the rest of the entire year. But you got to think about the better deals are going to be harder to find. And the amount of buyers coming into the market because of the bonus depreciation towards the end of the year is going to pick up. And so making those deals more competitive and going off the market like that. And so the better short-term rental deals that we're seeing actually move pretty quickly. And so with the median listing time, I think I mentioned this earlier, is like 56 days on the market. That's not for the best deals. The best deals go fast. So you need to be able to move, but now is better because there's just less people in the market. So we talked about supply. So point number 2 was supply, overall supply, just like the amount of supply entering the market has gone down. That growth has gone down. Number 3, the revenue potential in a lot of markets is there's a lot of uncertainty. Okay. I think a lot of people are, even in some of the markets I'm in, there's a lot of uncertainty about where we see short-term rentals going, which puts a lot of people on pause. And so it was funny. I was speaking to a client and they told me, they said, I don't want to buy right now because housing prices in the market I'm looking in are dropping. And I'm not sure that, it's a good time to really buy when housing prices are dropping. And I'm like, so you'd rather buy when housing prices are going up? Like, when are you buying? You're not buying. That's literally what, you didn't want to buy when you're saying they're too high. And now you're saying they're too low. Like, come on. And then it reflects back to the revenue. They're like, well, revenue's dropping. Okay, so we have to be a little bit more conservative on our numbers. But if it still pencils out, it still pencils out. I can't tell you, and this is a lesson I have personally learned. I'm going to be very honest on this, okay? Don't quote me on social media or tag me in something that I said this, but whatever. Like, I'm telling you, I'm just saying, don't rub it in my face. I am prejudiced against certain markets sometimes. Sometimes I'm like, I just don't like that market. And I don't see why anyone would ever buy there. And I never look there because I'm like, no. And it doesn't necessarily mean it's a bad market. Case in point, Broken Bow, Oklahoma. I think that market is, if you're a realtor listening to this and you're from there, I'm so sorry. But I just do not like that market. I don't understand why it makes sense to build $1 million homes there and, they cash flow short term. It just doesn't. Okay. And now that doesn't mean there aren't properties and people who found success there recently. I think that's, find me them, please, because I'd like to challenge that. But I just don't like that market. Okay. However, I've seen markets where I haven't quote unquote liked, where the prices drop and they become a lot more tolerable from a return standpoint. We're like, you know what? That actually makes a lot of sense. Even though revenue has dropped, even though the housing prices have dropped, buying right where that property's at, where that price point is at, makes a lot of sense because a lot of your expenses are your mortgage, right? Your payments and things. But it's dropped so far that the expenses are much lower than they were before, even though revenue has gone down a little bit. And it's now a really, really good deal. Whereas before that prices were too high and revenue was slightly higher. It's not as great as it was, it's higher than it was today, but it's not necessarily 30, 40% higher, but the housing prices were. So you're working with two different components when it comes to deals. It's not just about revenue. It's not just about the prices of homes. You got to put it together. And I would say a third element of it too is the operating costs. I'm seeing a lot of posts about insurance, and especially rising costs of insurance in Florida. I mean, getting an insurance for a condo is like $8,000 or $10,000 or something crazy like that. It's like, whoa, that's a lot of money for, there's 3 or 4 bedroom houses that are like $20,000 in insurance per year. That just destroys your cash flow. It could be the right purchase price and the right revenue, but if the insurance costs are too high, there goes your cash flow. So those three, like that 3-headed dragon, it's a balance of those 3 things together that make up the ROI. And so purely making a decision based on one and not acknowledging or looking at the other 2, I think is irresponsible, and foolish, because you could say, oh, wow, well, the revenue is really high in this market, therefore I'll make a lot of money. If you don't look at your expenses or if you don't look at the purchase prices, boom, you could be in trouble. And it works vice versa. Revenue could be down, but the others could have dropped significantly too, that make it still a good deal. And as a long-term play, and that's something I want to talk about too, as a long-term play, it makes a lot of sense. And we have to start asking ourselves this question: how long am I planning to hold this property? If you're planning on selling it tomorrow, then yeah, you should be more concerned about where prices are going, right? Because you're selling it tomorrow, but you're probably not, right? You're not selling the property tomorrow. You're going to hold on to it, preferably for at least 5 years, maybe more. I mean, it's up to you, but like at least 5 years. And over time, as we've seen, the longer and longer you hold a property, it naturally appreciates, even though there's ups and downs in the market. So think long term when it comes to the pricing and where things are at today, but also learn to take advantage of these things. I think of the stock market and people complain, oh, everything's like overpriced in the stock market. And then when it drops, people panic and they're like, oh, we're losing money. It's not, it doesn't make sense. It's like, well, you said it didn't make sense when it was high, and now it doesn't make sense when it's low. Like, when does it make sense? Right? So you just have to buy, but buy smart. Don't be an idiot about it. Like, run your numbers and things, but there isn't really a time in the market where it's just a bad time to like never buy. Okay. I mean, I would say like when COVID hit, the first like month or two that it hit, there was we just didn't know what was going to happen. Right? Like that was probably a bad time to buy. But you know what? If you were gutsy enough to buy, you could probably negotiate some really crazy deals during that short period of time there was of uncertainty. It's all about the uncertainty, and that's the risk standpoint, right? But you should all, like, if you're actively looking to buy, like, there's opportunities at any cycle in the market. And so it's just like it just goes back to the old saying, the old adage, when's the best time to buy? It's yesterday. The second best time is today. And that is so, so true with what's going on. Okay. So we talked about the 3 points so far. We talked about where the buyer's market, the increased inventory versus, in the amount of properties being sold. We talked about the supply growth creeping down. We talked about revenue potential. Don't just focus on, revenue is slipping, but look at prices, look at expenses. And then finally, or not finally, sorry, there's two other points. Point number 4 is the growth, like the runway. Short-term rentals aren't going anywhere. There, that says it all. Okay, they are a part of the economy. They're a part of they've been a part of the economy for a very, very long time. They're just getting now a lot more popular because people don't really like staying in hotels as much as they used to. And so if you buy right in the right location, and I think that's the point of this, is like buy in the right location, but focus on properties with a moat. If it doesn't have a moat, please don't buy it. Okay. Buying in the right location, buying properties that will withstand the test of time. That's what you want to look for. And so, because that's going to give you runway and growth over time. Just like home prices appreciate, your revenue can appreciate over time, but it can also, can dip a little bit and go back up. But if you're in a solid market, in a solid location, it's a vacation destination, in my opinion, you have like a base, a floor, and it doesn't matter if there's a ton of competition, saturation. If you're in the right place with the right property, well, you don't really have that much to worry about. And the long-term growth is a lot better. We are seeing, I've got some like stats pulled up here. Airbnb, the STR market, excuse me, it grew from just like in the amount of money, it grew about 7.5% year over year. So the amount of people, the demand grew about 7.5% from who was using it last year to this year. Remember, supply only grew by about it's almost 5%, 4.7%. So the demand is actually outpacing supply right now, which last year before it was the other way around. Really interesting, isn't it? So, and this is really cool. The market as in general, in revenue by the year, they're projecting by year 2030 is supposed to generate over $102 billion, almost $103 billion. And right now it's like at like 60 billion. So 5 years from now, it's almost going to double. Okay. Just by the growth and, even with the current growth trajectory, of what's going on. And so I believe There's tremendous opportunity in the space, and it's here to stay. It's not going anywhere. And so if you have that in mind, it's a positive outlook. It's not a negative outlook. In the short-term uncertainty that we're experiencing with tariffs and, saturation, competition in the markets, elevated design, the amenities arm race, things that I've scared you about for several episodes now. The reality is, if you understand the long-term positive outlook, then it's just a puzzle in figuring out with the right property, I can withstand all these other fiery darts, and hurdles that I have to go through like any other business, any other industry out there. All right. Point number 5. There are a ton of emerging markets still today. Okay. So just because the markets that you knew about or that everybody knew about a few years ago, it's really popular, aren't doing well today, doesn't mean there aren't other markets that are growing and expanding. For example, I bought in Dallas Fort Worth area recently. Okay. Guess what's coming in Dallas Fort Worth soon? Universal Studios is opening up I've known this for years now, but they broke ground a few years ago. They've been working on it's going to take years. Okay. Now, did I buy purely because of that? No. But the Dallas market has been growing population wise. So is Austin. So is San Antonio. So the Hill Country. People have to vacation. They're going to they don't have to vacation, but they will vacation. They want to vacation. And they will vacation, and drive-in destinations benefit from that drastically. There are theme parks opening up around the United States that are being announced. There's new ski resorts being announced. There's all these things, new things popping up. Doesn't have to be ski resorts. It could be colleges, universities, whatever it is. There are new things that are constantly growing or being put into markets, resorts and things like that, that really blow up a market and improve traffic or increase traffic to them. That can improve the the revenue and the potential in certain STR markets. And so we are seeing, especially near the large population centers that are growing, just go online, look at the top cities move to, and where do those people vacation to? And a lot of times those markets are doing very, very well. Okay. And they're usually within a 2 to 3 hour drive of those major cities. So I just told you how to find them. I'll go and do that. So go look at the top cities people are moving to, and then go look at the top vacation destinations for those particular cities within a 2 to 3 hour driving distance. And there you go. You're usually going to find an emerging market that's doing better year over year, because there are a ton of markets that are doing better year over year. They're just not as talked about as the big popular ones that everybody rushed to. So look, now is a great time to find those, because other people aren't doing that. They're not, they're scared. There's so much uncertainty. Oh, I don't know. They're not looking at these certain data and statistics. And as more time progresses, as people innovate and technology improves, we're going to find out more of these trends, and then it'll be easier for investors to find them and harder for you and I to find better deals. So let's talk about the 5 points again. So number 1, and I got to remember what the 5 points were, but number 1 was there's just increased more inventory. Number 2 is the supply growth has decreased. Number 3, be sure you understand, revenue, even though revenue has slipped, housing prices have really slipped, or getting there, and dropping where it starts to make sense on certain properties. Number 4, there's a long positive outlook in growth in revenue and in markets. And then number 5, there's a ton of emerging markets out there that you can find today. So understanding those 5 things gives me a lot of confidence in understanding that this is a buyer's market today, and I think will continue to be, and will give you opportunity and advantage in the future. I hope you enjoyed this episode. And if you did, please leave me a review. I would appreciate that. But also go check out the YouTube channel. I just dropped a really cool video on how to design and add the right amenities to your property. That's at STR Insights YouTube channel. I am Kenny Bedwell, and I will see you on the next episode of Cash Flow Positive.